This is Scott from Trader.com, and this is the educational program for the SI indicator and the specific setups that I use in my trading. And as you will see, they're very, very powerful examples of areas that you can take advantage of with other things that you're using in your trading. So all these setups going forward, I have 5 separate setups with over 50 or 60 slides, examples. These are all specifically just on the SI indicator volume setup. So it's not, I'm not incorporating anything else. So for example, I use the TAS market indicators. I'll also use VWAP, things like that. These are, again, the volume setups where you can apply this information to areas in the chart that you look at, things that make sense to you. VWAP, moving averages, the tops or bottoms of ranges, things like that. So this is to be used, to strengthen an idea or to confirm an idea that you have with what you use. So again, I've said many times in my webinars that I'm a firm believer you can just use this alone, this SI volume indicator, and then the volume information, the liquidity information on bookmap.com. But if you're going to do that, you're going to have to take advantage of every setup that comes your way, or else you're doing yourself a disservice and you're not playing the odds correctly. So for those of us that don't write computer programs and aren't able to catch every single setup in every market, then you want to incorporate this volume, the SI indicator volume setup, into your trading. So take a minute here to read this disclaimer. I'm not going to read it through and take 5 minutes reading it, but please take a look at this. It's been up the entire time I've been talking anyway, and then here's the second page of that. Okay, so our first setup is called the Dumb and Dumber, D&D. So I'll refer to it as D&D on my charts, so you know what it is. Also, in some of these examples, especially going forward, I'll have different setups on the same chart. So don't be confused by that. We'll get into that, especially as we get into the other ones. And when I have multiple on the chart, they'll make sense. But this is the Dumb and Dumber setup. It's the bookmap.com SI indicator setup number 1. So the Dumb and Dumber is a setup where we're playing against the retail trader, which I refer to as dumb money or uninformed money. The premise for this setup is when there's a significant stop run above our product threshold, which is obviously important, right? So you have the PDF for the product thresholds. The whole idea of that is you're not taking every single stop run and thinking that's relevant. You're only taking the stop runs that are above our thresholds, and that's from my research from having the SI indicator for 4+ months and researching all of these products on a daily basis. So again, I personally do not take trades unless they're above my product thresholds, which you have in your PDF. The majority of the time, it's retail traders puking, uninformed money again, and no real buyers or selling behind it, meaning there's no large players coming in after that retail puke. And we can fade that move with confidence. What we look for are stop runs where the market is immediately above or below the stop run area to trade in the other direction. The trade is taken when we see a stop run and when we see the corresponding opposite color bubble, which is aggressive market orders, and we place the stop above or below where the buyer sell stop initiated. So we'll get into some of these examples here. So this is E-mini S&P from May 29th. You can see here, so a lot of these examples I won't have both the icebergs and the stops on the screen, just to make it more clear for you guys. But you will see both stops and icebergs in some of these examples going forward. So this was the E-mini S&P on May 29th, where you see again this is the acronyms for the Dumb and Dumber, where you see a heavy stop run. We see 804 contract stop run. You can see there at the bottom. And then when we move So I'll show you both here. So we have that, and then we have another one up here where we have a buy stop run. So in both instances, the stops fired off the uninformed retail trader, and immediately we were above in this instance and immediately below in this instance. So the trade is taken when you see the stop run fire off and the market, again, gets above or below that stop run area. So in this case, we had a sell stop run, and the minute you see the blue bubbles, you're in here. Let me see if I can get this. You're in here, and then you're riding it to, again, you may have your own levels that you're considering. This is, to enter. You're not always going to get a perfect entry exit type thing like you do like you have here, but many times you will, and it's just, it's awesome to be able to at least hold a portion of your trade where you tell yourself, I'm not exiting that trade until I see the opposite setup, which it happened very nicely here for a 20 plus point move, right? So in this instance here, you had the big buy stop run, 674 contracts. Again, our threshold in the E-mini S&P is 500 stops or more, and then you see the sell bubble come in. You can initiate your sell order here. Your stop goes above here, so you're risking about five-ish points. And then I don't have the rest of the day here, but it, even if you were to, just catch this move here, this was a good 10-point move here. So, and then this one here again was, you're risking, if you were to get into the blue bubble here, right around 3,000, a little more, probably 3,001-ish. Especially when there's higher volatility as well, you'll be risking more, but you're going to be catching more too. So for instance, you may be risking 6, 7, 8 points here, depending on where this initiated. Again, I have this a little scrunched up. You can expand your chart to get even more precise with the prices. But you want to, you can tell by the volatility if it's worth risking that much. One, because the stop run will go that much further, right? And then, when you do enter the position, you can catch the 20, 30 point move. So, let's move on to the next one. So this is the Euro 6E. This was on June 22nd, and let me get this off here for you guys. So again, we have the heavy stop run here, and this was a kind of a double stop run where you had, and again, our threshold in the Euro is over 100 for stops. So you had 100 here, which is right about in this area here, and then you had another 114 shoot off here. So you wouldn't have been shorting here. Again, the part of the setup is you're waiting for red bubbles to come into the market, and that's meaning there's market sellers that are initiating. You don't want to be just jumping in against a stop run if you don't see any counter trade, right? I mean, if you just see blue bubble, blue bubble, blue bubble, that's going to be, more of a stop and hold, and that's one of the setups we'll get into. But again, you want to see the stop run fail, meaning it gets immediately below that area. And then you want to see the red bubbles start to come in here or here, type of thing. So you could either got in here or waited a little bit and started to see these come in again. You enter here and your stop goes again above the where the stop run went off, and then you catch obviously a very, very nice move down. One thing to note, there's a couple markets, and I'll point them out as we go through them. Some of these markets will come back and go a little bit higher, right? So many times, especially the Euro, you'll see a little bit of a move higher, and then it'll go. So, if you're conservative, you can wait, and the problem is that you may miss the trade, but you can wait for one more push above, and then when you see the selling come back in and it gets below, this area, then you can ride it out. But just be aware, there's a couple markets like 6E, bonds, gold, NASDAQ occasionally, though, and especially the ones that are a little more less liquidity trading. Bonds aren't really less liquidity. That's the only one that the rest of them are, pretty light liquidity. That sometimes it'll go a little bit higher, but then you can even if you get stopped out. And that's the other thing with these setups, right? Just because if you get stopped out once doesn't mean you can't re-enter the trade, right? Because when you catch one of these moves, you have, first of all, statistically very high in your favor that it's going to be a profitable trade. Two, you're going to get multiples on your trade. So you're looking at 3, 4, 5 or more times on your trade. So you're risking 1 to make 5, 1 to make 10. That means what's great about that is you can enter multiple times. So I personally will enter 2, maybe 3 times. After 3 times, if it doesn't work, I'm just done. I'm done trying to catch that setup, because it's not conforming to what I want to see. But don't be afraid to enter. So for instance, if you were to get in right here and then you put your stop here, right, and then the market moves up and stops you out, don't be afraid to get back in once it moves below this level, and give it another chance, right? Especially in these markets that I'm telling you tend to go a little bit outside of that area and then come back. Again, because when you're right, you're going to be making multiples on your trade, so you can afford to try it once or twice because you're not risking a lot on the trade. For instance, if you're in here, even here, you're risking maybe 10 ticks. I mean, from down here up here, you're risking maybe 6 ticks, 6 or 7 ticks, and you catch a monster 30, 40 tick run. So again, don't be afraid to re-enter the trade if you get stopped out the first time. Next example is, this is natural gas. And I'm trying to show you guys a bunch of different products, because that's the main thing of this whole program, of this whole educational program. Volume is volume. Volume works. These setups work in all 19 futures markets that I cover, right? Because again, volume is volume. Volume drives markets. When guys are caught, guys are caught. When the dumb money pukes, the dumb money pukes. It doesn't matter what market you're trading, and that's great, right? That's great for us as traders, where it's consistent across the board, where you can look at for these specific setups. As long as your thresholds are getting hit, you're good to go. So again, this was natural gas, and there's 2 setups here. Again, we're not, obviously we haven't covered breaking ice yet, but once you go back and look at the PDF, once we get through all of these, you can go back and this will make more sense to you. But right now we're just covering the Dumb and Dumber setup here, which was, this was the puke natural gas, and this was again 406 contracts on the puke, which is a ton in natural gas. We're looking for over 70 for the stop runs to make it relevant, to make us, pay attention and potentially take a trade. So when you start seeing, 3, 4, 5 times the amount, then you really should take notice and really be looking to, position yourself for a trade, right? Especially you take the stuff that you look at and, what your bias is for the day. And then again, in this instance, this is long, and hopefully you have a long bias, and this is your signal to get in this trade. So you had the sell stop 406 contracts, and then here's the blue bubble. You're in there, right around 1.796 ish. I would say you're risking down to probably 85 ish. So you're risking 11 ticks, and you catch a 20 plus point move. And why I have this on here too, why I have this breaking ice, is because again, this is another example where you could have been in the trade, and the minute you see something counter, that's your cue to get out of the trade or part of your trade, right? You may have a target up here, but again, you don't want to ignore when you see other SI setups come in. You want to be exiting some of your position, right? And that's another thing where most traders, their biggest weaknesses are when this trade starts going in the favor, they don't know when to get out, right? They see their P&L and they want to keep as much as money as that, the money's in their bank account right now in their mind, so they don't want to give that back, right? When you're using this stuff, you can feel confident, like you don't have to just get out to get out. You can get out when you see, opposite sided setups come in, then you're out. Or again, if you're using the TAS indicator levels or whatever you look at, you don't want to get out. My whole point is you don't want to get out just to get out. You want to get out. You need to have a reason to get out, and that's how you will make millions of dollars of trading eventually. Instead of like most traders where the thing starts to run in their favor a little bit and then they're out for no reason, right? This gives you reasons to get out, and we'll get into this this breaking ice setup coming up here. So the next setup is this is CL here. Get this off. So you got CL right there, June 23rd. This was another, obviously, Dumb and Dumber. This was a huge sell stop. Not huge, but it was significant. Again, our thresholds for CL for stop runs are, it's over 100, I believe. Yeah, 100. So this is 158, so that was, 1.5 times normal. And you see here, this stop run fired off here. The minute you see the blue, even here you could have got in, but here's some significant buying. And again, don't be afraid of the normal rotations, right? You know the area that it should not violate, right? So you shouldn't be getting back down here. So if you're in here, you're in around 40.71ish, and you're risking down to 40.60, I would say. It's right around here. So, you're risking 11 ticks and you can see this thing ripped. But another, so there's a conservative entry and there's an aggressive entry. The aggressive entry is getting in the minute it gets above this area. Let me get this off here. The minute you see the stop run and it's above it and you see opposite bubbles, that's an aggressive entry. That's the entry I take, but you're going to miss some trades, but if you want to be conservative, many, many, many times you're going to get a retest of that level, right? So you have the retest there, you have a retest here, you have a retest here. Again, you're pulling hair waiting for this thing to go, but this level is significant, right? And if it violates it and gets right back above, you can give it another shot. But the point is, this was showing how significant this area was with all these retests, and then when you finally get some buying, it's off to the races, right? These setups don't always occur immediately, right? Just like anything in trading, nothing's 100%, but you're in the right area and you know where you're wrong. You're risking very little to catch a massive trade. So the next one is silver. This was on 624. Again, you see the monster stop run. Again, in silver, anything over 50 stops is a lot. So when you start seeing, where's this thing to get off here so I can show you guys? Anyway, this is 349. I don't know why that's not coming off right now. There we go. 349 is 5 times normal. So that should really make you take notice. Like, okay, this market's going to be moving here big time. Because a lot of traders just puked, and again, there was no real selling behind that puke. And then the minute you see the blue, get this off here. The minute you see this blue, that's your entry. Your stop goes below this sell bubble. Again, here we go. If you're aggressive, that's where you're in. That's where I get in. If you want to be conservative, once again, here's the retest, the exact level. Not only did it retest with all market buying as it was coming down. That's also a very good sign, obviously, right? Because you don't even get any selling as it's coming down. You got guys aggressively buying the offers as it comes down here, and then off to the races, right? So again, remember, this setup is the puke is the retail trader, the uninformed trader. It's not the big money most of the time, and that's the way you need to approach it, where you didn't see continuation, big money past this area, right? So if you would have seen red bubble, you're not in the trade, but you'd see an immediate rejection, and then you see blue bubble, retest, gone, right? So again, you're going to see these patterns over and over and over again, and that's a good thing, right? So again, you use this in conjunction with what you're looking at. You can trade this just off the volume. You're more than welcome, but it makes it even stronger when you have very strong, chart areas that you're looking at that makes sense to you. Next example is even the S&P again. This was a 1,000 lot stop here. Let's see. So you have this here. As soon as you see the buyers come in, you're in. Your stop goes below here. And many times too, you can even put your stop. You can use this liquidity, which I've covered in many webinars. You can use this liquidity. I don't really go over it in this educational program, but it's pretty self-explanatory. Liquidity is just large bids or offers in the book, right? So it just displays it graphically in a different way to make it easier, like as a heat map. Anyway, you can put your stop just below here, or you can put it below this liquidity here. Again, I personally don't want to see this come back and violate this area, right? So when I see this blue come in here, I'm in. My stop's going just below here, so you're risking in this case about 2.5 points to catch a 7-point trade and more. I didn't have the rest of the day, or this was a live trade at the time. But even if you just catch this just up to here, this is a very nice 6-7 point trade. So then you also had a little bit up buying iceberg here, which we haven't even gotten over, but this wasn't threshold wise worthy, I should say. So this is a lot. 1,000 stops is double what we want to see in the mini S&P, which is anything over 500 is relevant. Go to our next example here. This is gold. So we had, again, the Dumb and Dumber setup. D&D plus means it's a buy setup. And we had the stop run here, 449 contracts. Again, monster stops. A lot in gold is about 150. That's our threshold. So you're looking at 3 times that. And once again, in different products, same exact setup. You get the move away. You can get in right here. As you see the blue, your stop goes here. Or you wait for the retest. And gold retest a lot. So you get in a gold trade, you can expect to be tortured for a while most times, right? So there's some of these markets, that's just the way they trade. These algos just have a hold on them, and they will where areas are not significant, they will just whipsaw you back and forth for an hour before it ends up going. So just be aware of that when you trade these different markets that I'm pointing out that do things like that. I mean, in gold, many times, like I said a little bit earlier, this was nice where it retested the exact level, right? And then it was gone. I mean, huge trade. Many times in gold, like I said, it will come back down. It'll violate, like right about here-ish. I mean, you'll see a little. You don't want to see it go, obviously, 30, 40 ticks, because then this is invalidated. But I'm saying if you see a quick swipe down and back above, you can re-enter again, right? If it happens again, you can give it one more shot. Again, that's up to you and how you trade, and you're willing to take a couple chances on these setups. But just be aware, again, there's certain products that will trade through the area a little bit and then go. Again, it's gold, euro, bonds, NQ, the NASDAQ. Those are the ones that tend to do that. So just don't be surprised if it happens, and don't be afraid to get back in, because, again, so say this went down here. Oops. 1 second here. Let me get my little arrow. So say this went down here, you got stopped out. Then you see it come back, buying again. You get back again. You get stopped out again, right? So now you're down about, so this entry here, right about this price, was probably right around 54-ish. You're risking down, 44, let's say 45. We're risking 9 ticks, right? So if you get stopped out once, say it came down here, you got stopped out. Say it came down here again, you got stopped out. So now you're 18 ticks in the hole. But when you catch one, you catch a 70, 80, 90, 200 tick move. That's the point. This is what this is all about, right? It's all about risk reward, where you want to risk a little to be making a lot. And this is what having this indicator affords you to do. You're risking very little in these areas, because the areas, if they hold, they should not be violated by much, that if you're right, you're going to catch the big move. Next one is this is crude oil. We had, it's kind of cut off here. This was 313. Darn it. Sorry about that. This is like 213 contracts. This is a bad slide. Sorry, I didn't notice that. There's about 213 buy stop run right here. So again, same exact setup where you get the buyers immediately wrong. As soon as you see the selling, you're in. Your stop goes above here. So you're in around 54-ish. Your stop goes around 61-ish. You're risking 7 ticks to make, this was 20 ticks and counting and more. Again, this was a lot. Well, this was a replay, but it went down. Even if you just catch a 20, 25 tick move, you're only risking 7 ticks. You're making, almost 4 times on your money, on your risk. That's the key. This is an example where, like I told you, you risk not catching the trade, because not every time will it come back and retest the area and then give you a chance to get back in. So Again, this is aggressive. It's not that aggressive because this trade is very, very solid. But again, for you conservative traders that want to see a retest and fail, this one did not. That didn't occur, obviously, right? So you would miss this trade. So just be aware of that. If you want to be conservative, you're going to be missing some trades. This was 6A Australian dollar. Again, you guys may be looking at this like, wait, I don't understand this, the size. This is only 67 lots, but obviously in Australian dollar, that's a lot of, that's a large amount. That's our threshold. So our threshold in Australian dollar for stops is 50. So if you see more than 50, pay attention. You can see all these other stops that fired off. They weren't even near that. I mean, this was probably the closest, but all these other ones throughout the entire day, not even close. So when you see an outsized stop run, you're ready to pounce and take the trade. So you had same setup here, right? And then the sell stop immediately above. You can enter right there. As soon as you see the blue, I think this was around 68.51-ish. You're risking down to say 40, 41-ish, right around here, and then you catch a 30 plus tick move. Again, you're risking 10 to make 30. Again, this doesn't always show you exactly where to get out. You're not always going to get an opposite sided reason to get out, but you want, that's where you're using the other stuff you're looking at. So when you take these trades, you want to have some kind of target in mind, whether it's the TAS indicators, a TAS resistance level, VWAP, the things that make sense to you. Then you can decide to start getting out. But you're not just getting out, again, like we just talked about, you're not getting out just because the thing starts to run in your favor. Catch these big moves. That's the whole point of these setups, where you can get multiples on your money, on your capital. Next one is NASDAQ. This was, again, a 164 stop run, buy stop run. And again, here immediately below it, you're in there, right around 97.22-ish, I would say. You're risking up to 97.26, which is nothing in the NASDAQ. You're risking 4 points to make 20 plus points on your trade, right? So you're risking 6 to make 20. Again, be cognizant of the NASDAQ doing one of these and then coming back up here a little bit, and then it'll go, right? So again, don't be surprised. Don't be afraid to re-enter once it gets back below here. So say it did that and it came in right here, you can re-enter right here, put your stop back above there, and then try to catch the move. Again, even if you're wrong twice, you're still going to be making, multiples on your money. But again, be aware, NASDAQ's one of those markets that tend to trade through the area. This one was clean. But again, if you're a conservative, it never retested either, just like that crude example. So, there's nothing, this isn't the trade I take. The minute I see the sellers come in below that stop run, I'm in, right? Next example is, this was from 625. This was crude again. Yeah, crude again. So this was substantial. You get a 330 buy stop, and you can see the rest of the day how much more significant that is. Again, same exact setup, same exact look. Here's the buy. Here's the selling coming in. You can be selling right around 39. Your stop goes right above, which is right about 39.13ish. And you're catching a 30, 40 point tick move, right? So again, this is, you're getting multiples on your money, and this is another example where it didn't give you a clean retest, right? So if you're not aggressive, you're not catching this trade, which is, some traders, that's fine. You want even more of an assurance of goes down, retest, and then goes. That's fine. Just be aware you're going to miss some monster trades once in a while. The other thing too is when you see this kind of size, when you start seeing 4 or 5, so our threshold in crude is 100 stops. When you start seeing 3, 4, 5 times our threshold, be more aggressive, right? You don't want to, if this was like 99 or 101, yeah, okay. If you want to be more conservative, wait for a retest, that's fine. But when you start seeing 3, 4, 5 times your threshold, be aggressive. You should be getting in here, right? This area here. Next example This is our last example. So this is the E-mini S&P again. This is a monster stop. Our threshold is 500. This is 2,200. Let me get my little thing. You get 2,200 sell stops, right? Again, uninformed traders, not the smart money, no continuation. It's immediately above it. You can get long right here, right around 47-ish. That looks like 47 a quarter maybe. It's actually a little less than that. And you're risking down to 45, right? Should not violate this. So you're risking 2 points to catch, this is 12 points in running. Again, 6 times your money on the trade. Same exact setup. Again, if you're not aggressive though, and just like we talked about, if the size of the stop or size of the is multiple, this is 4 times, almost 5 times the normal threshold what we're looking for. Be aggressive. Don't, I'm aggressive, and you don't want to hope it comes back and retest the area and you're going to miss a monster move, right? Again, if this was 500 or 498 and it's right there and you're like, oh, that's kind of close. Yeah, if you want to wait for it to retest, come down here, retest, and then go. I have no problem with that. But when you start seeing, monster size like this, you don't want to miss that. You don't want to miss this trade. Okay, so that concludes the Dumb and Dumber setup. Again, very powerful. These are all very, very powerful setups, but you're going to see as they start to kind of incorporate too, and as you start to get all these setups into your trading, you're going to be a very, very powerful trader. So we'll be back with the next setup. Thanks.